How expensive have homes become in Toronto? We're going to be comparing it to now versus the reality of the 1990s when the boomers were buying homes. And I'm going to show you some interesting statistics about how badly it has gotten now relative to before. And yes, boomers, we're going to be talking about when you had 18% interest. Now, if you're looking for some help on how to navigate this real estate market, because it's very weird right now and it's very much a buyer's market. I can tell you that the numbers don't quite say it, but the boots on the ground, the data, the way that buyers are behaving, the way that sellers should be behaving, but not really behaving right now is telling me we're in a buyer's market. And I honestly do not think it's going to change for the rest of the year. So if you are that person who's been on the fence or sideline because prices or competition has spooked you, yes, affordability hasn't gotten any worse, but imagine what's going to happen if affordability gets better, i.e. interest rate cuts. And now is the time we have so many options. Sellers, if they understand it, are going to be letting it go for less than what they should be. And buyers, no competition right now. So it actually is an opportunity right now, but obviously there are risks. And if you want to have that conversation with me about whether that risk is worth it and to start looking in today's market right now, then you can book a call with me using the link that's right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run and operate a RE/MAX in the greater Toronto area on top of making awesome educational real estate content just like this one for you. And if you found any of this content helpful in your real estate journey, make sure you spread the knowledge by smashing the like button and subscribing to the Prime Properties channel. Thank you very much. Now, the article we'll be covering today is how expensive has Toronto housing become? And we're going to take a look at today's reality versus when the baby boomers were buying in the 1990s. This was a great article to look back. And I'm going to talk to you about why I do think there's this metric that everyone seems to use, which is the average income to the average price. It is important, but I have dismissed this for quite some time already because affordability isn't really just based on your income to what the price is. And I'm going to explain more of that later. Now, when we kind of go through this article, a couple of things I'm going to highlight here is that in the last 3 decades, median incomes for individuals in the Toronto area have remained the same when adjusted for inflation, which is absolutely correct. So in my mind, I talked about this before, inflation is basically a silent tax on people, but they just don't understand it. And now that I think we're in an inflationary decade and people are starting to see grocery bills spike up, like the other day I went to buy a steak. It is so expensive now for 2 steaks relative to like 3 years ago. I think people are starting to understand what inflation is. So when you adjust for incomes in the last 30 years for inflation, you can even use minimum wage or median income, whatever the case may be, the buying power has not moved. But the things we're buying has got more expensive, meaning that we're now able to buy less things. Because for every $1 in the system, if you own, say, 1 penny of it, right, as a percentage of it, when we create more dollars in the system, that percentage you own is less and less. And that's what inflation does. Your buying power as a percentage of how much of the economy you own is varying smaller and smaller, right? So that's kind of the problem. And people are starting to realize that. And I want you to look at this information I'm about to show you with that kind of perspective. Not just like, oh, this is so expensive. It's 3x my income, 30x my income, 20x my income. No, you have to understand what that value and a percentage of your total ability to buy relative to the entire kind of pricing and economy is, okay? So you can see in this chart here, and one of the reasons why I want to talk about this article is they have both of these numbers, the dollar amount for the average home price and the average median income has been adjusted for inflation. So if we go back in time, you can see that if you were to buy a home in the 1990s, the average home was equivalent to what is today $514,000 when adjusted for inflation. And the income has not shifted, right? Now, when you look at in the 2000s, it's been 400, meaning it came down after adjusting for inflation. You can see in the 2010s, it's about 500 something, and now it's at 1.1 million, which is exactly where the number is right now. So because we're basically adjusting everything for the inflation number that we have today. And you can see this green bar here basically just shows that, look, incomes have not moved. And even when you adjust home prices for inflation, it's significantly increased, right? So you look at here, back in the 90s, you can see that it was about, call it 10 times the income. So remember, 10 times, right? Because we used to say, oh, it's 3 to 4 times. When adjusted for inflation in the 90s, it was 10 times. Now, when you're looking at 2000s, this is about 8 times. So it actually went down. Affordability got better, right? Based on this metric. And then we look in the early 2000s, this is about 11 times. So it got back to where, like the 1990s was. And now when we look here, it's about 20 times. So this is the average home price to the average median income. And that has gotten worse and worse over time. And you can see that. Now, my whole thing is we've always used this, average income or median income, whatever, to the average home price. And I say, yes, there's a sensibility in using that, but a lot of the times it doesn't make sense. And I'm going to show you some affordability stuff later because it's dictated by interest rate and inflation, right? But I have a lot of data I've been tracking for a very long time. And you can see basically here, and I want to explain this to you, okay? The blue line is basically the average price that I took from the Toronto Real Estate Board. The orange line has been the average income. Okay, it's a little bit off from the median, but more or less the same. And none of this is adjusted for inflation. And this is strictly from StatsCan. And you can see that this gap in between has been the multiplier. And this gap has progressively gone bigger and bigger. And now this gray bar I put, it's basically what the multiplier is. So as of 2022, you can see that it takes about 22 times the average income. Let's just assume, you marry someone or you have a partner that's of the same income, you can divide by 2, so you're at 10 times the income, which is still kind of nuts. But we've talked about this before. You don't start buying a home with the average home, because right now, the average $1.1 million home, it would be like a semi in Toronto, kind of like dilapidated depending on where, like a Victorian or something like that, right? Like 3-bedroom, 1 or 2 washroom, maybe 3 depending on the area. Or you can go into the burbs right now. So like if you're in New York region, you can buy a townhome for like 1.1 million. That's like 10 years old, right? Or you can go really, really far out and call it like in the east end of Durham, or maybe even like Peel region. You can maybe get away with like a semi, right? So that's kind of what the average home is right now based on this price. But people don't start off with that, right? So people generally start off with the average condo. So you can see basically here that it's about 14 times the income to buy your entry-level condo. And this is what I'm gonna say. Right now in this current market, because investors are liquidating a lot of the smaller entry-level condos and there's tenanted inside, buyers with the ability to kind of evict, for lack of a better term, the tenants are able to get deals on these because sellers have to sell because they have to deleverage, and the tenants unfortunately are being displaced. But this is how you are actually able to take advantage of the current market right now. And this is what I was saying in the beginning. As a first-time home buyer, there's a lot of things in your favor right now with the exception of affordability. But are you going to get all the stars to align? And if you're waiting for that crash, it may not happen. But if you believe so, that's your prerogative. That's perfectly fine. But right now, of the competition, choices, and affordability, you're checking 2 of the 3 boxes right now, which you generally don't get, right? So talking about kind of the average income to the first home, it's a little bit easier. And if you were to have, say, a person, like your partner, go in with you, it's about 1 to 7 times, which is not bad. Now, of all of the things I just told you, understand that these are all the average income or medium income to the home price. But it doesn't talk about really what affordability is, because we are not factoring the fact that interest rates drive prices. Let me repeat that. Interest rate drives prices, because if you think about it, when interest rates are really low, your affordability is based on what everyone just talks about. What is that monthly payment? Because you don't go in to buy the home and be like, oh, hey, it's $600,000, $1 million, $1 million, $1,002,000, whatever it is. We go look at the monthly amount. Hey, your monthly payment is $3,000, $4,000, $5,000. This is inclusive of property taxes, maintenance fee, and everything you want to put in, right? Or the pothole fees, whatever. So we always look at that. And that amount, that monthly payment, is dictated by what the interest rate is. Because let's be real, most people are buying a home with a mortgage, right? Call it 80%, 65%. That's generally what it's looking at right now. So when you apply a lower interest on kind of your payments, kind of remember the pandemic when interest was like a 1.5% for mortgages, your affordability was really, really good because your monthly payment shrank down significantly. Now, remember, we had a lot of people talking about negative amortizations. There's a reverse to that. When interest rates dropped as low as possible, you still had your, banks that had negative amortizations, right? But what happened is when the rates dropped, your payments didn't change. That's why people didn't understand this. Because right now, those payments where negative amortization haven't changed and the amortizations grow like crazy. But it works in the reverse. So during the pandemic, and I'm going to talk about this a little bit more later, those payments that you were making, that you had like a variable from like 2018, 2019, and when it dropped to 1.5, the principal payment on that was through the roof because the interest payments dropped down like crazy. So people paid off their houses a lot. So that's why people didn't talk about it. So the chart I do want to show you is this housing affordability index. So you can see exactly right here. The reason why I want to use this, it's because it's a percentage of related home expenses as a share of disposable income, meaning that your housing related expenses fluctuates with the interest rate based on renewals and whatever, right? So you can see in the 90s, right, it was about 55%. So when we go back to the article here, the $500,000 adjusted for home, it's about 55% of your income. So that's a lot, right? When we look in, say, the early 2000s, when affordability after adjustment went down, it got better because prices came down, interest rates came down a little bit after the dot-com boom, right? Then when we look at 2008, affordability spiked up a little bit, but then it came back down afterwards because the rates dropped a little bit. Now, Toronto didn't really feel much of it because it was more of a US thing, right? But we had like to get looped into that a ton of times. And then when we look at 2020, you see over here when the pandemic hit, look, affordability dropped like crazy. Prices went up like crazy. And this is why I want to show this to you. Your monthly payment is very much dictated by the interest rate. And this may sound very trivial when you're hearing me say this right now, but a lot of people don't understand this. So when we look at the housing affordability right now, and we're trying to make things affordable, high interest rates do not help. They do not help. Look right here. We're basically back at 50%. Can we get to 55%? Absolutely. How can that number change? Well, you have two options. Prices come down or interest rates come down. What's going to happen next? I bet you prices are going to come down first. And this is why I'm saying, as a first-time buyer, if you can find a seller who understands this and they're willing to sell it for less than the market, knowing that you're going to get that price before the interest rates go back down, making it more affordable, making more people come in, making prices go up, just like the pandemic, then yeah, now's a good opportunity to buy. But if you don't believe that, then you should stay on the sidelines, right? So when we kind of look at what's going to come down first, prices or interest rate, I personally, like I said earlier, I believe prices are going to come down first. But at some point, are interest rates going to come down? Yes, I think so. Have we hit that peak? Maybe. We may get another 25 basis point hike in October. I don't know. But at the moment right now, the variable and the fixed are both in the low to mid sixes right now. And there's no spread difference really between the two of them. And people are kind of confused about which one to get, because you go variable because you know what? If the Bank of Canada is at the limit for how much it's going to raise, maybe we go to variable because I don't want to get stuck with a 6.5% rate for the next 3 to 5 years. And that's kind of a dilemma right now, which tells me that a lot of people are believing that rates are going to come down. But is it going to come down before prices? No. Which means that affordability, in theory, should get better because prices are coming down. But when those rates come down, call it mid-2024 or end of 2024 in 12 to 50 months, what's going to happen to affordability? I bet you it's going to improve if they drop the rates. And when they improve, it means prices are going to improve. And this is why I'm saying the opportunity lies right now for the people who are trying to buy a home, and they can actually handle this a little bit because you're going to get kind of the purchase price drop down when you can find a motivated seller. And that's what makes the most sense. Now, as a seller, should you sell right now? Absolutely not. It's a terrible time. But the problem is, if you need to sell, then you have to sell because you want to cut off the part that's kind of cancerous to your portfolio or your home so that you don't have to lose your primary home. This is why so many condo sellers right now are investors. They're terminating some of their cash flow negative condos so that they can survive to fight another day. If this makes sense to you and you kind of want to explore the options of whether you should be entering the market right now, you could book a call with me using the link right here. It's www.chatwithzen.com. Hope that kind of gives you an idea of what's happening in the real estate market. And yes, I know baby boomers, you were buying stuff with 18-20% interest, but when we look just at the affordability, this is what it is. It is equally just as unaffordable when you baby boomers bought the home back in the 90s. It is that bad right now. Anyways, I hope this helps. Until next time, your move, your future. See ya. Now that I'm done watching this video, I think you should check out this video. And you know what? Why don't you check out this video too?